host, Sarah Berry, CPA, Texarkana, Texas, here with another Tax Tip Tuesday. And today we are going to be talking about fixed asset purchases for all of our small business clients. We have joining us today Keisha Booth. She is a staff accountant here at our office, and she is going to be leading this discussion. Keisha, if you would like to start us off.
Okay. One of the first questions we get asked a lot is, does purchasing a new asset save you on your taxes?
Yes, so we do get asked that a lot, and purchasing a fixed asset can help you on your taxes. So it all boils down to the specifics in the asset that was purchased. So it depends on what type of asset it was purchased, when it was purchased, and such like. With the tax reform, there were some changes in how we can depreciate assets. And when we say depreciation, we typically are talking about writing off the asset purchased or deducting it on your tax return. So depreciation is just a fancy word for deducting a fixed asset. So now we have the option of Section 179 or bonus depreciation, and those two are very similar now since the tax reform has passed. So yes, purchasing an asset can help you on your taxes.
The second thing we get asked a lot is, when selling an asset, is there a gain recognized?
Yes, we do get asked that a lot, and there can be a gain recognized when you sell a business asset. There could also be a loss that is recognized when you sell an asset, and it really just all depends upon how much was paid for when you originally purchased that asset, how much you sold it for, and there's that fancy word again, the depreciation that has been taken on the asset from the time it was purchased until the time it was sold. So now I'm going to switch over here to my screen, and I'm going to show you a couple examples. So you have asset A and asset B, and they were both purchased for $50,000, and they were both sold for $40,000. But one of them, when you sell them for $40,000, you're going to have a $30,000 gain, and the other one you're going to have a $10,000 gain. And so it all boils down to, what is the previous depreciation taken on those assets in previous years on the tax return. So if I had purchased this asset for $50,000, I had deducted $40,000 on my taxes, my adjusted basis would be $10,000. When I sell it for $40,000, I'm going to show income of $30,000 on my taxes. So the question is, will I have to show income on my tax return when I sell an asset? The answer is, it depends. It's very possible.
It's my understanding that the rules have changed in regards to traded in assets.
Yes, that is very true. So one thing about the tax reform in general brought a lot of changes to our tax world, but one thing that changed was the way that we treat an asset when it's been traded in. So in previous years, let's say you traded in a vehicle and got a trading allowance of $40,000. So that $40,000 was not shown as income on your tax return. What we did was we did this fancy calculation as your remaining basis compared to your trade-in value, and we rolled that over into the basis of the asset that is obtained, so the new asset purchased in that trade-in. So now those calculations are different, and if you got a $40,000 trade-in allowance, it's actually treated the same as if you went out and sold that automobile for $40,000. So that's the way it has changed. Now, the net effect of that for most people is nothing. So you're not showing the income in previous years, but your asset is lower. So now you are showing income in that trading allowance, but you get to take the entire purchase price of your new asset. So for most people, it's not having a net effect on the tax return as long as we can structure it correctly. But for people who are self-employed, it can actually be a positive thing because that gain on that trading allowance is not subject to self-employment taxes, but the entire purchase price of your new asset is a deduction for self-employment taxes. So it actually can be a good thing.
Last and most important point is to make sure you bring your CPA all of your invoices for your new assets.
Yes, that is a very important point. And the main reason why we did this video was to explain that the purchasing and selling of assets, it can be pretty complicated, and it all depends on the specifics of that taxpayer and the specifics of what piece of equipment was sold and what piece of equipment is obtained. So it is very important that we get these invoices on these asset purchases, preferably throughout the year. It really helps with our bookkeeping if we get these invoices throughout the year. And the best case scenario is if you consult with us or your CPA. If you have a different CPA, you need to consult before you sell an asset, because as you can see in that example that I showed, selling asset A for the same price gave you a vastly different result than selling asset B for the same price. So if you consult with us prior to selling an asset, consult with us before purchasing an asset, it could be possible that you need to shift income in between years, and waiting the day before Christmas to the day after New Year's could make a pretty big difference on your taxes. So if you can communicate with us ahead of time, make for sure you send us those invoices on the purchase. And that's all that we have today. Thank you for joining us, and we'll see you next week.